Welcome to our deep dive on how S-Corporation owners can maximize retirement contributions using a solo 401k. First, we will clarify who qualifies, then we will connect the dots between W-2 payroll and contribution potential. Next, we will break down the employee deferral and employer profit-sharing rules and show you how spouse participation can multiply savings. Finally, we will cover implementation steps, deadlines, and a few advanced tips so you avoid common pitfalls. Let's get started. Here's today's agenda. First, we will confirm eligibility and structure. Next, we will explain why W-2 payroll drives solo 401k contributions in an S-Corp. Then, we will detail contribution mechanics for both the employee deferral and the employer profit-sharing components. After that, we will compare SEP-IRA and solo 401k in an S-Corp context. Then, we will walk through implementation steps. Next, we will outline what counts in W-2 Box 1 for the 25% employer contribution calculation. Afterward, we will highlight timelines and deadlines. 5. Finally, we will run examples, test with quick quizzes, and end with key takeaways. Let's start with eligibility and structure. A solo 401k, also called an individual 401k, is designed for an owner-only business and can include a working spouse. Crucially, there must be no common law employees. The plan is established under the S-Corporation's name. Compared with a SEP-IRA, a solo 401k often allows significantly higher contributions thanks to the employee salary deferral feature. With that foundation set, let's transition to the most critical driver of savings in an S-Corp: W-2 payroll. Now, the S-Corp payroll mandate. In an S-Corporation, your solo 401k savings potential is directly tied to W-2 payroll compensations. If you do not pay yourself W-2 wages, you cannot make employee deferrals, and you also cannot receive employer contributions. Conversely, once you do have W-2 Box 1 wages, you can make employee deferrals, and the S-Corp can make an employer profit-sharing contribution. If your spouse is also on W-2 payroll from the S-Corp, they can defer and receive employer contributions separately, creating a powerful stacking effect. With that key rule in place, let's move to how contributions actually work. This mind map shows the big picture. Starting with eligibility, solo 401ks are for owner-only businesses, optionally including a working spouse, with no common law employees. Next, compensation is central. W-2 wages from the S-Corp drive contributions. And for 2% or more shareholders, S-Corp paid health insurance and HSA amounts are included in Box 1. Then, contributions split into two pieces. The employee deferral is shared across all your employers, while the employer profit sharing is generally up to 25% of W-2 Box 1 for each participant, subject to the overall annual additions limit and compensation cap. Coordination matters. If you have an outside W-2 job with a 401k, your deferral limit is shared, but employer contributions are calculated separately by employer. A spouse on payroll has their own deferral and employer calculation. Finally, note deadlines. The plan typically must be in place by year-end for employee deferrals. Employer contributions can generally be made by the tax filing deadline, including extensions, and deferral elections must be made before payroll. Always verify your plan document for the precise definition of compensation and eligibility terms. Let's break down the two contribution buckets. First, the employee deferral. You can defer up to the annual IRS maximum, but that limit is shared across all your employers. So, if you are already maxing a 401k through an outside W-2 job, you cannot defer additional amounts through the S-Corp solo 401k. Second, the employer profit-sharing contribution. Generally, the S-Corp can contribute up to 25% of each participant's W-2 Box 1 compensation. Importantly, employer contributions made by other employers do not reduce the S-Corp's ability to contribute, because employer contributions are computed separately by employer and by participant. Coordination is key. Deferrals are shared across employers, but employer contributions are not. If your spouse is on the S-Corp payroll, they have their own deferral and employer contribution calculation. For optimization, reasonable W-2 wages can increase the 25% base, and including certain items in Box 1 can further expand the potential employer contribution. Next, let's compare a SEP-IRA with a solo 401k in the S-Corp setting. Here's a side-by-side comparison. On the SEP-IRA side, contributions are employer only. There are no employee deferrals. Setup can be simpler, and contributions may be coordinated across businesses. This can be straightforward, but may limit strategies, especially if only one participant is involved. On the solo 401k side, you combine employee deferrals with employer contributions, often allowing higher overall savings potential. If a spouse is on the W-2 payroll, they can make their own deferrals and receive employer contributions, which can materially increase household savings. However, there is added administration, including adoption documents, ongoing tracking, and filing Form 5500EZ once plan assets exceed the filing threshold. Some solo 401ks also offer Roth deferrals, depending on the provider. With that comparison in mind, let's move into a practical step-by-step implementation. Here's the practical workflow. First, determine reasonable W-2 wages for the owner and, if applicable, the spouse. Second, choose a solo 401k provider and adopt plan documents under the S Corporation's name. Third, open the plan trust account and choose whether to allow traditional or Roth deferrals if the provider supports them. Fourth, set up deferral elections before payroll runs and integrate those elections with your payroll system. Fifth, withhold and remit employee deferrals through payroll and fund the employer contribution by the tax filing deadline, including extensions. Sixth, track annual limits, compensation caps, and coordinate with any outside 401k participation. Seventh, retain plan records, and once assets exceed the filing threshold, file Form 5500EZ. Review the plan annually for any updates or changes. Next, let's identify what counts in W-2 Box 1 for the employer 25% calculation. This table highlights how specific items affect the Box 1 compensation used in the employer 25% calculation. Base W-2 salary is included in Box 1 and therefore counts. For shareholders owning 2% or more, S-Corp paid health insurance premiums and S-Corp paid or reimbursed HSA contributions are included in Box 1, which can increase the contribution base. S-Corp distributions, accountable plan reimbursements, and certain fringe benefits are not included in Box 1 and do not count toward the base. Pre-tax 401k deferrals generally reduce Box 1 and therefore reduce the 25% base, although the precise compensation definition can differ by plan document. Always confirm your plan's compensation definition with your provider, or CPA. With the inputs clarified, let's put this into a timeline of key deadlines. This timeline underscores practical deadlines. First, the plan typically needs to be adopted by year-end if you intend to make employee deferrals for that year. Second, deferral elections must be in place before the payroll in which the deferrals occur, because elections are prospective. Third, employer profit sharing can generally be funded by the tax filing deadline, including extensions. Early in the next year, make sure W-2s properly report 2% or greater shareholder health insurance and S-Corp paid HSA amounts if applicable. Finally, once assets exceed the filing threshold, file Form 5500EZ annually by the due date. With timing mapped out, let's solidify the rules using a couple of realistic examples. Let's apply the rules to two examples. In example A, the owner already maxes employee deferrals at an outside W-2 job. The S-Corp pays the owner $80,000 of W-2 wages. Because the deferral limit is shared, there is no additional employee deferral available through the S-Corp. However, the S-Corp may still make an employer contribution up to 25% of the S-Corp W-2 wages, or $20,000 in this case, subject to the overall annual additions limit and compensation caps. In example B, we add a spouse on W-2 payroll. The owner earns $120,000 and the spouse earns $40,000. Each participant can make their own employee deferral up to the annual IRS limit, coordinating with any other employers, and each may receive an employer contribution up to 25% of their respective W-2 wages. This allows the household to stack retirement savings across two participants. As always, verify current year IRS limits for deferrals, any catch-up contributions if age 50 or older, the annual additions limit, and the compensation cap. Next, let's test your understanding with a quick quiz. Quiz time. Question: if an S-Corp owner pays themselves $0 in W-2 wages, how much can they contribute to a solo 401k? Options: A. Only employer contributions. B. Only employee deferrals. C. Both employee deferrals and employer contributions. D. $0, no contributions are allowed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is D. Without W-2 wages from the S-Corporation, neither employee deferrals nor employer contributions are allowed. W-2 pay is the prerequisite to solo 401k funding in an S-Corp structure. Next, let's try one more quick question about coordination with outside plans. Second quiz. Question: you have already maxed your employee deferral at an outside W-2 job. What can your S-Corp still contribute to your solo 401k? Options: A. Nothing at all. B. Only additional employee deferrals. C. Employer profit sharing up to 25% of your S-Corp W-2 box 1. D. Unlimited employer contributions. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Even if you have already used your employee deferral limit at another employer, the S-Corporation can still make an employer profit-sharing contribution based on your S-Corp W-2 wages, generally up to 25%, subject to overall limits. Now that we have confirmed the key rules, let's capture the main takeaways. Here are the key takeaways. W-2 wages drive solo 401k eligibility and contribution capacity in an S-Corp. Employee deferrals share a single annual limit across all employers. Employer profit sharing is generally up to 25% of W-2 box 1 compensation for each participant, calculated separately by employer. A spouse on W-2 can stack savings with their own deferral and employer contribution. For 2% or greater shareholders, S-Corp paid health insurance and HSA amounts included in Box 1 can increase the 25% base. Be mindful of deadlines. Adopt the plan by year-end for deferrals and fund employer contributions by the tax filing deadline, including extensions. Finally, confirm your plan's compensation definition and check current IRS limits each year. Before we wrap up, here is an important disclaimer. This content is educational and does not constitute tax, legal, or investment advice. Your facts and plan document details matter. Consult your CPA, an ERISA attorney, or your plan provider for advice tailored to your circumstances. Now, let's summarize everything we covered. In summary, a solo 401k inside an S-Corporation can deliver substantial retirement savings when W-2 payroll is properly configured. Use employee deferrals strategically, especially if you do not already max out deferrals at another employer. Leverage employer profit sharing, generally up to 25% of W-2 box 1 per participant. If applicable, consider adding a spouse to payroll to build two separate contribution streams. Confirm which amounts are included in box 1, such as 2% shareholder health insurance and S-Corp paid HSA contributions, as those can increase the employer calculation base. Finally, meet plan adoption and funding deadlines, maintain good records, and file required forms. As we close, here's a quick note. Thanks for watching. If this was helpful, please like the video, share it with another S-Corp owner, and subscribe for more practical strategies. In the comments, tell us your biggest solo 401k question for S-Corp and what you want us to cover next.